What? What? What do you think is going on, everybody? It is 12:30. That means that you and I have an appointment. That's right. It's time to discuss it with Drake. So welcome to episode number 99. You know what happens next? Well, actually, you don't know what happens next, but the next number is the big 100. And you don't want to miss it. That's all I'm going to say. So welcome to episode 99. And today's quick topic is, how does a Heloc work? What is a Heloc? Well, if you don't know, you need to find out. Hola, so of course, before we get started, please keep in mind if you ever miss a live broadcast, simply just go over to YouTube and type in Drake's Real Estate TV, hit subscribe. All right, so if you stop by, please say hello in the comments. I'd greatly appreciate it. Let's get started. So, with home values having risen so dramatically over the last decade or so, many homeowners are looking for ways to tap into their equity without selling their home or refinancing. Refinancing their primary mortgage. So, if your home has gained significant value since you purchased it, and most of them have, or if you've just paid so much of your mortgage down that you've got equity to work with, a second mortgage actually might make sense. Home equity line of credit, a Heloc. They're popular options for homeowners in this very situation. They're flexible loans that give you a lot of options and time to decide what you want to do with your equity. But they can also be a bit confusing at times because they don't work like a traditional home loan. So let's talk about this. Helocs are lines of credit. The most important thing to keep in mind when it comes to a Heloc is that unlike a traditional home equity loan, Helocs, they're lines of credit. That means it means that they work more like a credit card than a mortgage. So you're approved for a line of credit that represents the maximum amount of money that you can charge to your Heloc. Just like your credit card. And your payments are based on how much of that line of credit you've used. So if you max out your Heloc, you can pay it down and then charge again, just like your credit card. Unlike a credit card, however, your home is being used as security for this loan. So if you get in over your head, your home is at risk. All right? So you must be very careful when you use this particular kind of credit line. Helocs also have two separate loan periods. So Helocs start as their lives open as lines of credit, allowing you to charge or pay off as much as you want at any given time. You usually expect it to make at least an interest payment each month, but beyond that, you could charge a lot or little and only based on the percentage of the credit line you've utilized. This is known as the draw period, This period of the Heloc, where it functions as a line of credit, is usually about 10 years, but can be more or less, depending on the loan that you take out. Immediately following this period, your Heloc actually becomes a set loan and you can no longer charge anything else to the line of credit. In the repayment period, your Heloc actually becomes much more like a traditional second mortgage with a payment that's based on the amount of credit you ultimately used during the draw period. From here on, your payment is more or less fixed, but can vary if you have an adjustable rate loan. The repayment period is usually about 20 years, but again, it can be different based on your agreement with your bank. I left the window open and now you can hear a truck pulling in. Lovely. Be careful here though. There's often a balloon payment due at the end of the repayment period. So if this is a concern for you, make sure that your loan either will fully amortize or that you're paying extra each month to ensure that your last payment takes your note to a zero balance. There are a few Heloc requirements. Let's talk about those real quick. Like other home equity loans, you'll need to be able to qualify for a Heloc with a reasonable credit score, ask your lender for specifics, a debt-to-income ratio of about 40% or below, and of course, a high amount of home equity. Most lenders won't lend more than about 85% of your home's equity back to you in case of default, So of course, there are exceptions to every rule, so it's very important to consult with multiple lenders before you make your final decision on who will be servicing your Heloc. You'll also need an appraisal to assess the current value of your home, as well as minimal closing paperwork to finalize and record the loan. So that's all I have today. I hope you found it useful. Thank you, Homekeeper, for providing all the information. Remember, next week, 100. Please come and watch, okay? It could be beneficial to you. You never know, all right? As always, please don't keep me a secret. Share this with everyone you know. If there's a topic that you let me discuss, I have no idea what's going on next week. I might not even talk. I might just see who shows up, and they are going to like it, okay? I hope you have a fantastic week. Please be kind to one another. Don't forget to live, laugh, and love, okay? And until we see each other next week, when the next move matters, contact Day for Homes. See you guys.